You're listening to Real Investor Radio with Fuhr and Jack BeVier, where we cover advanced real estate investing topics to help you stay ahead of the curve in your real estate investing business. Welcome back to Real Investor Radio. I'm Fuhr with Jack BeVier. Jack, it's good to see you.
Yes, sir. Good morning. Good morning.
It's our special holiday edition, Jack.
Kicking off the holiday season. It's cold.
It did get cold. We are no guests here. Jack and I are just riffing on sort of the year, sort of a recap of what we saw over 2024 and maybe some predictions, what to look out for as a real estate investor in 2025. Jack, we spent all of the last episode. I encourage everybody to go back and take a listen about your trip out to Scottsdale for IMN. Some of the things you learned from better investors out at the conference over the last couple of days. Literally, you just got back last night. And I think the general tenor was, people are just sort of a little, trying to feel their way through a tough time transactionally. Transactions are obvious. Finding great deals right now is still difficult for most. We feel like the money's going to be there for you for these deals if you find good deals. Better operators are figuring it out. But one of the takeaways for me on the last episode, Jack, was, it's time to get good at operations and it's time to get really good at finding deals because, it may stay like it may be a tough transaction environment for the next several months.
Yeah, definitely. And I feel like the real estate investor is kind of getting it from both ends right now. You got a weak consumer, so houses are not exactly flying off the shelf, showing activity's low.
Yeah.
And then you've got a higher interest rate environment. We thought we were headed back down, but now we've come back up. So it's not like you can go refinance and get a bunch of cash flow. So deals are becoming a lot of deals are becoming debt service coverage constrained when you go to refinance, which is tough for your liquidity, right? Like real estate's a capital intensive business. It runs on cash. If you can't get access to your cash, you can't go buy more houses. So then, how do you make payroll, right? So it all starts with that finding great deals. So that still remains the holy grail right now. But that's table stakes, right?
Sure. Always has been.
But the capital markets environment isn't doing anybody any favors to make it easier right now.
My thesis, Jack, wrote down here at what does 2025 look like for real estate investors? And I wrote down three things. Better operators are going to prosper. Because one, you will have figured out how to either run your rental portfolio effectively and efficiently. You will have figured out how to find deals in a tough deal finding environment. And that alone, at least it was for me, Jack, back in 2004, 5, 6, 7, 8, when I became really great at finding houses and, putting in the value with our great contracting staff to make beautiful houses. That seemed to attract a lot of equity. I did most of my deals, as you know, with little to no of my own money, because I had so many people coming out of the woodwork saying, now there's a guy that kind of knows what he's doing. I'm willing to be the equity guy on that. And then finding the debt through a company like Dominion or some other private lender was generally very easy. So my thesis for 2025 is better operators, guys who really know their businesses are going to prosper because their access to equity will probably be a lot easier. And then finding the debt is generally fairly easy still in this market. What do you think about that?
Yeah, no, I think that's totally fair. The thing that I think the big risk factor, the big pitfall is going to be cash flow because it's been a tight environment. It's just getting tighter, and liquidity for selling houses is now lower, right? It's less predictable than it was. Not that you can't sell houses, but showings are longer. Home inspection reports are pickier.
Are we still finding though, Jack? I mean, you guys Dominion Properties is still putting out great product for sale rather than just for rent, even though you do both. Are you still finding though that houses that are rehabbed nicely, that where you go in and do a really nice job, are they still selling quickly, or have showing times, days on market gone up considerably?
they're still selling. And they're still selling, within 30 days, but it's not the first weekend, right? Like, it's not definitely the first weekend. And I still, there's this adage that your first offer is your best offer. I think that usually, and that's like been annoyingly true. So I still kind of think that that's a useful heuristic. The offer market though is thinner, right? You're getting fewer showings and fewer offers on even a beautiful house in the right location. And of course, I'm speaking on a relative basis, right? This is relative to like the market 2 years ago or even 12 months ago. Mm-hmm. But we've maybe seen a little downtick in prices. I think that that's something that we're going to see in the data that comes out. It won't come out until January or February, right? But like the October, November contracts, I think are lower, like on a nominal basis than the August, September contracts.
It's not a time to be pushing value.
No, I don't think it's a time to be pushing value. Like, I'm pricing competitively right now and like trying to get two offers competing against each other. Sometimes it works, whereas before you were like, a year ago, you could, if you priced a little aggressively, you were like gonna get a bidding war. And a lot of people use that strategy very effectively. Right now, I'm pricing aggressively to make sure I get an offer in the first 30 days. So yeah, it's a tighter market, or a more difficult market.
So in the last episode, we talked about sort of, folks, whether or not they're bearish or bullish on a Trump presidency. And I don't know that we need to get into all the ins and outs of that. But obviously they're looking to some austerity in terms of trimming down the size of government. Who knows whether or not they can get Congress in line with trimming down the size of the budget, which obviously is up, 50% since 2020 and the massive spending increases that happened as a result of COVID, post-COVID. We'll see whether or not they can get tighten the purse on from a congressional standpoint or not. Hopefully they will, because I think that all of that additional spending has only led to the inflation that we see today. But guys like Warren Buffett, Jack, hoarding cash right now, selling off major positions in Apple and Bank of America. And this is a guy who generally doesn't sell much. I think he's in the strongest cash position he's ever been in, some $350 billion sitting in cash right now. He also owns about 4% of the bond market right now, larger than what the Fed owns right now. And then JP Morgan, Jamie Dimon, said back in 2008 that he would never be caught in a position like that again, where he couldn't go out and buy when the market was presenting buys. And so they're sitting on close to $1 trillion in cash right now. And I think that speaks to a lot of what a guy I've been listening to, a guy by the name of Ed Dowd, look him up, D-O-U-D, used to be a BlackRock hedge fund manager, big macroeconomic guy. He owns a company called Finance Technologies now. And one of the things that he's kind of sounding the alarm on, Jack, is three major economic factors that are just really flashing red right now. And they are credit spreads, the yield curve, and S&P volatility. And we can get into the importance of each of those. But basically, he's saying, credit spreads are historically tight right now. And what that really means is that there might be more exuberance in the top of a market, people really not judging the risk of the market accordingly. And so they just keep plowing in. The yield curve, which is something that you and I have talked about previously on episodes, has been inverted, where the 2-year is giving off more than the 10. And so like if you take a look at history, anytime there has been a yield curve, an inverted yield curve, I should say, it's always been followed by a recession. And it's something that I think a lot of us have been waiting on over the past year or so. But frankly, when you put in an additional $2.5 trillion of government spending into any market, that staves off a recession pretty good. And then finally, the S&P volatility, which is historically low right now, which again just means that there's a lot of folks that are just still plowing in money to it, not really basing the risk that might be associated with the S&P right now. And frankly, 4 companies basically controlling the S&P right now. So any thoughts on that and sort of what that portends for the next 6 to 12 months? Ed Dowd saying that he sees a massive pullback of crisis proportions, maybe by March of next year. And Trump will have basically 2 years to figure that out, or else, you're going to see a change in Congress, or, a change in the House and a change in the Senate in the midterms. And that'll make him basically a lame duck for the following two.
What's he saying is the trigger, and what's going to happen? Like a stock market crash, or?
Well, I think it was more of a banking sector.
Not crash, but.
So if we take a look at the beginning of 2024, there were a couple major banks that failed, kind of got memory hold. The Fed stepped in, bailed them out. But you and I have talked briefly on previous episodes about the office market right now. We're seeing a lot of volatility in multifamily right now, and a lot of banks are sitting on that paper. And so I just think he sees it as a banking / stocks, correction. He's saying of somewhere between 30 and 50%.
Wow, that'd be something. So I just read, I promise this is related. So I just read Ray Dalio's book, The Changing World Order, which, have you read that? I highly recommend.
If you're not inclined to read the entire book, he did a video compendium series that really outlines it spectacularly well on YouTube. All you have to do is look it up on YouTube, where he narrates the entire thing, and it's done with graphics, and it's very compelling. I listened to it a few times. It's a lot to take in for a guy of limited intellect like myself, Jack. I'm sure you remembered it all. But what was your takeaway on that?
Well, I found it very convincing. Which was very disturbing.
Very disturbing.
So, for those who haven't read it, he basically looked back into history and tried to look for patterns of economies and countries and empires literally over thousands of years, right? Like he's looking for hey, is there something fundamental going on here?
And it wasn't just subjective. This is empirical, mathematical, of historical facts that he went through. It wasn't just some guy just conjecture.
Go ahead. So he's compiling the best macroeconomic data that we have going back thousands of years and looking for patterns in behavior. And he found them. He found a long-term debt cycle and short-term debt cycles that he goes into a bunch of detail that we won't go into right now. Go watch the video. And but the kind of the Cliff Notes conclusion here is that we've done all this before. This is nothing new. There's nothing new about what we are going through right now. The details are different, but this rhymes very much with stuff that has happened many, many times before.
Going all the way back to the Ottoman Empire.
Yeah, and that there's something about human nature that leads to patterns in economic cycles, right? And fundamentally, we are the same monkeys that we were 1,000 years ago. And if you just on a different time scale.
It usually starts with some sort of world war where the monetary policy and sort of the world monetary policy is then figured out via a Bretton Woods.
Yeah, it was the most recent one.
Most recent one, obviously, where, the world is weary of war. They don't want to get back into war. There's one winner, and that winner then has a world reserve currency. And the further you get away from the war, the more the empire tends to get a little lazy. They start outsourcing. They start using monetary policy to print more money. And the politicians obviously have no appetite for austerity.
Yeah, we can't balance a budget.
And
that's not new.
And in the case of say, Great Britain, who really was the shipping power of the world back then, they start outsourcing their shipbuilding to other countries, and those countries then become powerful. And so they
become ascendant. Yeah, they become the ascendant countries or economies. Yeah.
And so in our case, the analogy would be between us and China, obviously. So I think that when you take a look at the videos or you read the book, Principles of the New World Order by Ray Dalio, what you find is an amazing parallel between where we find ourselves today, internally and externally, with where these empires of the past have found themselves. So go ahead, Jack.
Yeah, and the conclusion is that we're pretty we're pretty late cycle in
Yeah.
this pattern. I think he splits it into like 6 parts, and we're like solidly in like 5. We're like 5.5.
Yes, we are.
And the thing is that they generally conclude with some currency devaluation or series of currency devaluations, because we can't balance the budget, so we need to print money. We need to either, so you tax the rich to try to help balance the budget, but that's just a short-term effect. It doesn't change the underlying like trajectory of the economy. Like those macro factors are still working against the in our case the United States, relative to the other ascendant powers in the world. And so, I think that we'll probably see higher taxes at some point, but that'll stave things off for a couple of years. But ultimately, the question is like, I guess the argument is when, not if, the US dollar ceases to become the world's reserve currency. But that'll only happen, like that may not happen for decades and decades, right? So we're not planning our businesses off of that. But in the meantime, the stuff that happens before that is an increase in taxes and potentially a series of devaluations of the currency to try to fix the underlying budgetary issues, right? Because balancing a budget is not politically palpable, but inflation is a tax on everybody. And so in printing money, no one really, like the US consumer doesn't really understand that. No one gets pissed off, as pissed off as they should about printing money, but it's a tax because it's just a tax on everybody, and it's and you do it by handing out money, right? So it's a very political, way to be
politically expedient,
popular, pretty expedient way to deal with budgetary issues, but it's ultimately weakening the fundamental reserve currency, and I just think that's going to happen, right? Like that. So I'm expecting over the course of the next 10 years, right? Like we're going to see a series of increases in taxes and periods of high inflation / money printing to deal with rolling over our debt, right? To enable to just kick the can until eventually we kick the can so much that in 2100, the US dollar is no longer the reserve currency of the world. But that leads me to think that like, so investing in hard assets is like, so hey, what are you going to do? So what are you going to do about it? Well, and like I'm always so freaking pro real estate, but like this is one of the reasons why is that invest in hard assets, like because that's a hedge, because whatever the denomination is, that house is got like fundamental intrinsic value as shelter. So whatever, whether we're trading in US dollars or raspberries, like the house has some value.
Right. And but let's be honest, one of the things he does talk about is not just a decline in the value of the dollar, but a decline in the value of all assets. And that may be temporary, but that's not to say that that real estate or your stocks or your 401k couldn't be revalued as well in a down.
But it's better for stocks because it's better for stocks and hard assets than it is for cash and bonds, especially long dated bonds, like long-term bonds. Because if you invested in a 30-year mortgage, like if you were the lender on a 30-year mortgage and the value and the currency just keeps being printed, it makes it easier to repay, right? Like your purchasing power keeps going down. Well, the big loser there is the one who made the 30-year loan, or the one sitting in cash as inflation erodes the value of that cash. So it suggests, to not get into long-term bonds. It suggests to get into hard assets and or the stock market, though you've got to have the stomach to ride the volatility of the stock market.
Why would guys like Buffett and Jamie Dimon be sitting on so much cash right now?
Yeah, so I feel like that suggests that that's more of a short term, that they think that they've got a shorter term view that they're going to be better deals, which is super interesting. I'm my eyebrows certainly raised based off of what you're talking about there. It is, they're not dumb, and they're not putting it in hard assets, right? They're not like hunkering down. They're getting ready to go on the offense, it sounds like. So
yeah.
Worth paying attention to.
Which leads me back to, sort of the Main Street investor. If there's a downturn coming, I just think that means better deal flow. I think it means, good things for the average investor, Jack, but only if that investor is sitting on some cash or has access to cash.
Yeah, true. I agree. Weaker consumer scary, right? Though, like if that happens, the consumer is going to feel poor.
Well, let me stop you there. Let's just speak from an investment standpoint. We lend, millions of dollars every month to real estate investors, Jack. In a downturn, Dominion's not closing their doors. Even though obviously you're sort of repricing the risk and sort of figuring out, okay, I've got this investor, he's got a great deal, single family house in some great neighborhood, some highly desirable neighborhood. He's getting it for a great price. He's going to put some value into it. You're still lending on that, right?
Yeah, to borrowers that can make their payments, though, right? Like
Of course,
liquidity,
yeah.
liquidity matters.
All things being equal, you've got to have a good borrower. You got a solid borrower, knows what he's doing, good credit. What's the one thing the bank worries about the most? How do we get paid back? And so let's assume that that's the case. Companies like Dominion still lend in tough times. Yes.
Yeah, definitely. We continued to lend in the downturn in 2008, 2009, 2010. It's not like just because we were underwater on a chunk of our book, but
that you made prior to the downturn, right?
Yeah, and defaults were way up, and we were working through all that stuff. But that didn't mean, not every single loan was in default, right? So we were getting payoffs from the most liquid borrowers, right? It was the folks who had the operating capital to withstand it and just take their lumps and sell the property where the market cleared and moved on.
Right.
But we couldn't just hoard that cash. We needed to continue to lend to keep the lights on, right? That's how we make money. And so, yeah, we continued to lend all throughout the downturn. We were catching a falling knife the whole time, right? Because we were trying to peg where value was going to be within the next 12 months. And we were fortunate that, lending at 70% loan to value generally meant that it was, that you could make that work as long as people didn't trail the market down. But yes, to answer your question, yeah, we continue to lend. We will continue to lend. Yeah.
Having gone through that, how does that prepare you for the inevitable next time it happens, Jack? I mean, you went through a lot. I mean, I remember vividly you telling me about what it was like for you and Fred to go through 2008, 2009. How does that prepare you and Dominion for what would be the inevitable next downturn?
Yeah, it very much informed our credit culture and perspective on appropriate risk taking. What we ended up finding, there was lenders that would talk about hey, I've got a lot of I've got relationships with my borrowers, and I lend based off of character.
Yeah.
And when the downturn happened,
character's out the door, baby.
Those guys got tossed the keys. Character showed itself. And we had a lot of defaults, but not the entire book. Everyone was underwater. 100% of borrowers were underwater in that period of time.
Absolutely.
But not everybody tossed us the keys, or not everybody was underwater. Everybody was was losing money. Everyone was losing money, but not everybody tossed us the keys or forced us to foreclose. And what we ended up finding was that FICO and having a decent FICO and filing your tax returns and having some of your cash into the deal were the three primary determinants of character. That's actually what really quantified character. And FICO does a pretty decent job of quantifying.
How did a company like Dominion ride out that storm with I would assume hundreds of loans that you had made versus a bank like Slavi, let's say? There was a tiny local bank here in Baltimore that made hundreds and hundreds of loans to real estate investors like myself. They've been in business for 110 years, Jack. And so how did they not weather the storm, but you guys did? Was it because of the regulatory environment that they were pressured under and Dominion, and a company like Dominion is not? Were you guys just smarter? How did you fare so well, but they did not? And frankly, 13,000 other small banks across the country that have all gone out of business since then.
Yeah. I think it was two things. One is, so the pat on my back, I'll pat myself on the back and then be here's the other side though. So the pat on my back is, I think we rolled our sleeves up and worked with borrowers, and we were operational about the real estate and understood the business more. And I think we did a good job of proactive loss mitigation to try to encourage people not to trail the market down. And sometimes that was being aggressive about it. Like, hey, like, no, like, this is what you need to go do. Not just, hey, we're not, we suggest that you drop the price.
Right.
But the other side of that is that the banks are regulated. And so if you had marked our balance sheet to market in the second half of 2008, a significant portion of our equity had been wiped out. And if we were a bank, they probably wouldn't have let us continue to operate. Now, we were still cash flow positive because we could take the losses to equity over a long period of time. But we amortized those losses we recognized those losses over years. So they all happened within like a 24-month period.
Yeah.
But we wrote them off for the next 4 years after that. And so we would just worked our way. And so we just didn't make money for many years, right? Because we would make money that year, but then we'd write off some of those, some 2008 losses. And then we'd make money the next year, but then we'd offset it and write off the 2008 losses. And then, then the next year, the 2009 losses. And we just did that for like 4 years in a row. And if we were a bank, they might not have let us continue to exist if we had been forced to mark our losses to market all at once.
How much do you think, Jack, that one of the things I love that Fred says often on the company calls is that he still believes that this is very much a relationship business. Not so much in that, hey, if you've got a great relationship with your lender, the loan is a done deal. More that it's really time for better lenders to really understand the businesses of the borrowers. And even in this very competitive environment that we're in, lending environment that we're in, Jack, I mean, we have no lack of competitors in this business. But how much do you think it's really going to be important over 2025 for the average loan officer, account executive to really understand the business of the borrower?
Yeah, so I think that's actually like our biggest focus in 2025 is getting excellent at that aspect of it.
I do too. Why now, Jack? Why is it so important now?
Because the operating environment is more difficult and cash flow is harder right now. In 2021, it just didn't matter, right? Like you didn't need to know, like
if you fogged a mirror and had a decent deal, it was going to be just fine.
Yeah, exactly. But and liquidity,
even if you had a crappy deal, it would work out.
Yeah, and liquidity was just not liquidity wasn't an issue, so nothing ever went sideways. It's become more important to have for lenders to understand the practical realities of boots on the ground, particularly with permitting issues and cost increases. But stuff was still moving, and now stuff's moving slower, and there's kind of nowhere to run with this higher interest rate environment. And so I think cash flow pressure, liquidity pressure is becoming more ubiquitous. Like that's becoming the theme of guys who are having a more difficult time. And I mean, if your attitude is like, hey, we're gonna default you because we're at the maturity date, which some lenders do, then they're screwed, right? Like if you're a borrower in that environment, you're gonna get screwed. And so we're trying to be very proactive about monitoring rehab progress, right? Like, hey, we're 50% through the loan, but you haven't taken a draw yet. Like getting that guy on the phone and be like, hey, what's going on? Like trying to figure out like early in the issue, if there's an issue, if there's something that we need to do, some restructuring that we need to do, rather than wait to the maturity date and he's completely out of cash for him to then just stop making payments, right? So we're trying to like really be proactive about communication because I think that that cash flow pressure is what puts people down, right? It's not that real estate prices don't go down and kill people. It's the lack of liquidity that really creates the wave of defaults first. And I think that's what we're keeping our eye out.
I've been on the phone with a few borrowers that appear to have their marketing operations in gear. And I'll get a call from a guy and we'll do a loan for single family house, small multifamily, something like that. 3 weeks later, I get a call. Hey, I've got another one on the books. Can you guys do it? Yeah, I'm super interested. But what we find in some of these cases is that they just don't have the liquidity. They might have the down. They don't have the liquidity for the interest reserves or the interest that we would look for in terms of liquidity to make the payments, or maybe they don't have the operating capital for the rehab, draws. And so I couldn't agree more. I think the better operators, Jack, are going to figure out the deal flow. Look, if you're a guy and you've got it and you know what you're doing, you've been doing this for 10 years and you say to yourself, we're going to do 25 houses next year. You're probably going to do 25. The question is whether or not you'll have the liquidity to do the 25.
Yeah, I think that's absolutely the case. And it's super frustrating, right? Like if you've gotten the deal flow aspect of things down,
So true.
like you just want your damn deal funded, right?
Right.
And you don't want to be asked like, hey, hey, but I think it would be a mistake. But I think it would be a mistake. And it's really hard to be introspective about your own business and say like, hey, but do I have the cash flow to make it through all of this successfully? In an environment where it's not selling on the first weekend with multiple offers and no financing and inspection contingencies. That's not the environment. Like you're
where you might be chasing the sale price down, rather than.
Yeah, exactly. Yeah. Like you worry about where you're pricing the house right now. And then the closing process is not going to be less than 30 days. It's, you may have to sell the thing a couple of times and make payments all along the way. And keeping the rehabs moving quickly is important, right? Like if you run out of cash and you can't progress your projects, you're hurting yourself because you just end up, it takes longer. So you're paying more money in interest and you bleed slowly and you don't realize that in real time, right? You just make the payment and, if you're managing off of your bank account and like, hey, how much cash do I have in the bank account? And that's what I'm going to do for the next, planning out the next 2 weeks. You'll look back at the end of the project and be like, oh my God, like I didn't make any money.
Yeah. What did I just spend the last 6 months of my life on to make 10 grand on a deal? Right.
Yeah. And that's demoralizing. Right. And that pushes guys out of the business. So we're truly trying to encourage people to like, think about their cash flow planning, not just, did you get a great deal? Yes. Congratulations. That's super freaking hard right now. Like congratulations. But hey, capitalism doesn't care, right? That's table stakes. Do you have the cash flow to make it through this project is the second order question that I think is going to distinguish success in 2025. I think that's going to separate the wheat from the chaff in 2025 in terms of operators.
Cash flow often doesn't always come right out of the borrower's pocket. It comes from friends, family, and fools, as my old mentor used to like to say. And that's why part of my, my number one bullet point on my 2025 thesis for better investors is to be a great operator. Really be able to sell your deal if you don't have the cash, the liquidity needed for that fifth deal when you're already working on number 4, you better be a good enough sales guy and have a really great operation to be able to go to someone with deeper pockets and say, hey, I need some liquidity for this. This is what I'm willing to give in terms of your return on that. Because I think when you have that, a better lender who understands your business like Dominion Financial is going to step up and lend you the debt on it. Correct?
Yeah, it's going to be an interesting year for sure. I think it's a harder operating environment. There's more risk to it. I am nervous that not everybody is seeing it that way or behaving the way that you're talking about, but I couldn't agree more.
I think with any new administration, there's always going to be some glass broken. But I just see the dramatic changes that Trump is suggesting in his administration. Look, it could turn out great. It could be the best thing that ever happened to the country to have smaller government, to really trim down the budget, to close up some agencies that really are doing nothing, like the Department of Education, send it all back to the state. However, there's going to be a tremendous amount of glass broken. And I just think that for the investor market, that could create some serious opportunities. Look, we're in the backyard of DC here, Jack.
Yeah, I was going to say
there are 2 million people who work for the federal government in and around DC. Some of the richest counties in all of America are around the DC and 695 Beltway.
Mm-hmm.
And so if you're looking to, do what Elon and Vivek want to do with Doge and get rid of half of those people, there's going to be a lot of empty houses, man.
Yeah,
it's going to create a lot of broken glass, and broken glass, blood in the streets is what makes people rich if you are prepared to take advantage of that.
Yeah, no, that's fair. I completely agree with that. Cash is going to be so circling back to your original point about Warren Buffett and JP Morgan. So, cash is going to be king in that operating environment.
I'm calling all of my better borrowers over the next week or so, Jack, and I'm really diving into what is your plan for 2025. Let's talk about your marketing. Let's talk about your goals. And let's talk about the cash that you have in place to be able to take down that many deals, whatever those deals are. I mean, we talk with guys that are, building 40, 50 houses a year. We talk with guys who are buying small to mid-size multifamily. We talk with guys who do hundreds of single family houses a year. And I really want to understand their businesses from an investor standpoint. And I think that's one of the unique things about our company, Jack, the company that you and Fred have created, is that you're not just lenders. You guys understand the business because you're in the business. And I think there's very few lenders out there who come at it with that unique perspective.
Yep. We'll see. We'll continue to try to distinguish ourselves in 2025.
Jack's being modest right now. So I just, it's an interesting time. We hope you guys have enjoyed this very special holiday episode, Jack. And we'll see you guys again in 2025. Jack, we have some amazing guests that are lined up over the next several weeks. And I don't have that list in front of me, but I know you have a couple that you're really excited about. Maybe we should preview that real quick, and then we'll end this episode.
Yeah, I'm really excited. We've got somebody from Zelman and Associates, Tony McGill, who is a partner there. They're like the preeminent research analyst for home builders and all things housing research, huge M&A investment bank, and publish incredible research. So I'm really excited to have Tony on. And then we've got Peter Linneman, who is a professor from the University of Pennsylvania Wharton School. He's a real estate professor there. When I went to Wharton 20 years ago, and he's like the rock star professor. He's like the guy who everyone wants to get in his class. You can't get in there. Everyone's like trying to audit it, and you just literally, there's no seats in the room. And he continues to be a consultant. He publishes a quarterly newsletter that's a deep dive into all things real estate. So yeah, super. I'm really excited to have him on as a guest. So that'll be a lot of fun.
Well, it's been a great 2024 with Real Investor Radio. I would encourage everyone to go back and check out some of the episodes that we've had with really, really top-notch investors. It's just been such a joy. Jack, I thank you for the time that you put into it. Gab, our producer, it's been great. We're going to finish up this year-end episode here, and we'll look forward to much, much more in 2025 as we all continue to get better and make it through the next year. It's going to be a wild, wild year, I'm sure. Jack, great seeing you.
Absolutely. Pleasure as always.
See you all next time on Real Investor Radio. Take care.